I think, of course, as you've indicated right now, the macro environment has been very tough. It's been tough globally. It's been tough regionally. We are a regional bank. And of course, it's been particularly tough in South Africa, which is our biggest market. So if we look at what that has meant for us, is we've got a very large consumer business relative to our broader balance sheet. And with the strain that we're seeing on the SA consumer, of course, those loss rates are higher than our through the cycle expectations. Apart from that, we follow a very specific interest rate risk management strategy in South Africa that gives us price stability over time. But when you see rates move as fast as what they have in this case, which both impacted consumers and their ability to pay, as well as our hedging strategy, you see the negative consequence of that. So if you think about consumer distress and the impairments together with the hedge impact, that of course has a significant drag on our earnings in the short term. Apart from that, because of our regional footprint, we see volatility coming out of some of the markets that we are present in on the continent, and that is specifically Ghana, in a market that is hyperinflationary, and we have to adjust for that. That is very specific to our earnings, together with a markets position that we had in Nigeria. Because of the policy changes that we've seen in Nigeria, the Naira depreciation, we've also seen that impact in our results. So if you normalize for that, we are saying that in a broad earnings perspective, we are disappointed, but underlying the franchise is in a very healthy position.
I'm curious about the CIB business. What was the driver there?
The CIB business followed a very specific strategy since our reset post Barclays. But their strategy was a function of the broader group strategy that we set post 2018. That strategy was a function of a couple of things. Firstly, diversification away from our South African business. As I said just now, our business was largely a South African business, and it was largely a consumer South African business. So we were very clear that we needed to diversify away from consumer, and equally we have to diversify away from South Africa. So two areas in that. Firstly, we want to build a Pan-African CIB business, which was also at the time mostly an asset-led business focused on South Africa. And we want to increase the contribution that was coming from our non-SA businesses. And we've seen both those areas perform very well in the last cycle. And we're very encouraged by both the increased CIB contribution to earnings. If you look at their actual earnings, their non-SA earnings is now close to 50%, which is the ambition that they set themselves in 2019. And the Arrow contribution that's now just on 30%. So we encourage strategically that we've made the right choices and we're getting the diversification benefits that we wanted to see.
We've been talking about the pressure on consumers, not just yourself, but various other players in the industry. What's your sense of the consumer's financial health from your perspective as Absa, and also their ability to settle their debts?
Yeah. So I think what's important is that when you talk about the SA consumer, I think it's important that we take a step back and just see what has happened post the pandemic. As the rates started turning from a very low cycle, we saw the rates move very fast in a very short space of time. So we saw 470 basis points of movements in less than 18 months. That sort of movement in such a short space of time makes it difficult for any consumer to adjust. If you then add to that real income growth that has been negative for the last 2 years, and you look at the increase in cost of credit, to your question, that has moved by over 35%. That means it's difficult for consumers to adjust, to their responsibilities, and that is exactly what we're seeing, not just in Absa but across the industry. I think what's important is, as that happens, that as Absa we stay very close to our customers. So as we see that pressure build up, we work with our customers to help them to deal with that fast adjustment, to ensure that if customers are willing to pay and they've got the ability to pay, that we help them through this shock cycle that they had to experience.
With that said then, which areas are you managing that credit risk?
We're managing credit risk across our full portfolio. So if you look at our SA business, we've got an unsecured balance sheet, which is both cards and personal loans. We've got a significant mortgage business and a VAF business, and of course a relationship banking business, and then corporate credit in the South African space, equally across the region. So in a cycle like this, it's very important that we look at risk management across our full risk management life cycle, not just in terms of how the back book vintages mature, but also how we think about risk coming through the front book. And it's a balanced process that we follow to ensure that we stay comfortable with the risk in our book.
Are there areas of the business, or perhaps even the business segments, where you believe you are gaining market share?
Nastassia, I think what's important for us here again is the journey that Absa has been on. So if you look at pre-2018, we've had 5 or 6 years of consistent market share losses, specifically in our South African business, but we also saw that in our businesses outside South Africa. So strategically for us, it was very important to reset that momentum in our franchise. And as a consequence of that, we deliberately decided that we wanted to grow market share across all our segments of our business, not just in South Africa, but across the region. Very importantly, that we do that in the right way, in a very measured way. We refer to that as fair market share. So excuse me. So if you look at our market share growth since 2018, it's been around 24%, which is in line with the fair share that we believe we should get across our businesses. In the macro environment, the way it is now, very important that we think about growth in a very measured and a very calculated way. So our focus is very much on ensuring that we book high quality customers during this cycle to maintain our focus on growth, which is one of our stated ambitions that we've very clearly articulated.
Are there areas of the business where you may not have been traditionally strong, but you see opportunities for growth and opportunities for it to go to the next level?
So I think you've touched on that very early when you spoke about our CIB business. Our CIB business was very much a South African asset-led business at the time. If you think about our regional businesses, it was contributing as little as 20% to group performance. And then if you look at our SA consumer business and our business banking business, unsecured lending, specifically in the personal loan space, is an area that we weren't comfortable with. Our levels of market share sitting at 10-11%. And equally our relative share in SME. If you look at where we find ourselves today, our CIB business has completely transformed themselves into a fully functional, fully diversified CIB business. Our Arrow businesses have shown the growth that we were looking for from the region, that's now contributing as close as 30%. And the unsecured journey is something which we followed on a slow path to ensure that ultimately over time we increase our share there. Excuse me. Now, over a period of 5 years, we've grown unsecured lending market shares in personal loans specifically from 10% to 11%. So this is not a quick process. It's a process that will take its time, but we've got to go about that in the right way.